As a strategist and someone who loves to talk about capital markets, stocks or equity are the focus of most financial blogs, podcasts, research, newspaper articles, and why shouldn't they be? Over the long run, they generate the most returns. We get to talk about fascinating topics like artificial intelligence, biotechnology, more than 100 industries, along with a few thousand companies making everything from paper cups to technology that someday might help us reach the other side of the solar system. Every now and then, we stumble into a stock that goes 10x, enforcing our belief that we have somehow mastered the markets. Well, I'm guilty as well. But as rewarding as stocks are, for many, placing all of your capital in growth assets is financial malpractice. We need some choices. And for the last couple of centuries, fixed income and its role in the 60-40 portfolio has been your go-to tool for most investment houses and advisors. Unfortunately, as any bond investor will tell you, this has been a challenge for years and has clearly not provided the income and, more importantly, the protection that investors should demand from risk-off assets. Take a look at the Ag ETF, which is a good proxy for the Bloomberg Aggregate Bond Index and a benchmark for most fixed income funds and portfolio managers. In the last 3 years, you lost about 7%. Even in the last 5, you still lost money. And if you were brave enough to hold on for the last decade, you made a whopping 13%. I don't mean annually. I mean, that was your total return. Now, there's no evidence he actually said this, but Albert Einstein is believed to have coined the phrase, insanity may be defined as doing the same thing over and over and expecting different results. Well, we need some answers, and we need them right now. Continuing to invest in a strategy that hasn't worked for 10 years and may not work for another 10 is insane. Welcome to The Money Runner. I'm David Nelson. It is time to think outside the bomb box and start coming up with alternatives that, in addition to providing negative correlation with other risk assets like stocks, actually make some money. Historically, when the Fed cuts rates, bond investors stand to make a lot of money all across the curve. But so far this cycle, that has not happened. The Fed funds rate this cycle has been cut by 100 basis points. And today, 10-year Treasury yields are up 100 basis points. So depending on the vehicle, that turns into about an 8% loss. In hindsight, the reasons why traditional fixed income strategies have failed are obvious. Ben Bernanke ushered in the era of quantitative easing, sending the world down a path of financially engineering economies in an effort to eliminate the business cycle. Now, I think few would argue with the necessity during the great financial crisis. Financial markets and institutions were on the verge of collapse, and the depression that would have followed was likely worth the cost. Like most things in life, too much of even a good thing has unintended consequences. The hangover or ultimate cost may be more than you bargained for. The Fed continued to use QE tools for years and didn't stop until March of 2022. This, of course, ushered in the era of zero interest rate policy, a period that wiped out savings for conservative investors, leaving them with few alternatives to generate income. The good news is that a Fed balance sheet that ballooned to almost $9 trillion has shed close to $2 trillion of that debt, as Jay Powell and company have continued to bleed off the excess. But normalization has a cost, and we may be feeling some of that on the long end of the curve today. If the Fed was the only reason fixed income hasn't worked like it has in past cycles, I'd say we were on a path of repairing the damage. But one look at the income statement and the balance sheet of the United States of America ends that fairy tale once and for all. High debt and ballooning deficits don't matter until it does. The good news is our GDP continues to expand, and with the introduction of new and exciting technologies like artificial intelligence, the productivity benefits might someday give us a GDP print of 5%. But as I pointed out in last week's podcast, 2025 Market Mission Brief, total U.S. debt is starting to rise exponentially, and that has not gone unnoticed by our creditors. LPL's chief fixed income strategist, Lawrence Gillum, has done some excellent work on this subject. He points out in a recent note that term premium is making its way back into fixed income. Term premium. Wonky word. What is that? It is the extra return investors expect to receive for holding longer-term bonds instead of short-term securities. It's been depressed for years, but as you can see in this chart, it is climbing and may continue to climb for some time. Even if the Fed cuts more than expected, long rates may continue to rise. When you are running debt and deficits this large, supply becomes a factor. And like any commodity, when there is excess supply, prices go down. And in this case, forces yields higher. Okay, we've laid out the problem, so let's look at some of the solutions. We have two jobs in front of us. First, we need an asset class that either has negative correlation or at least reduces downside risk when conditions deteriorate. There are several, and ultimately the solution will likely be a basket approach using multiple funds or ETFs for each asset class. Let's get the easy solutions out of the way first. The barbell. One of the easiest ways to reduce your risk would be a 60-40 split of stocks and bonds, only this time use the short end of the curve with treasuries 2 years or less. No, you won't get the negative correlation that you're supposed to get from long-dated treasuries when economic conditions soften, but you haven't been getting that anyway. When you look at a chart of 10-year yields alongside the Bloomberg Economic Surprise Index, bonds aren't acting like they're supposed to. In the last few months, the index has trended lower, and yields should have trended lower as well, but here they are on I-95 North. Let's build out the barbell. Let's say you have a 2-year time horizon. Today, you could lock in a 2-year treasury at 4.2%. All right, we're starting with $100K. If you were running a 60-40 portfolio and put $40,000 into that 2-year note, you would generate just over $3,400 over the next 2 years. On the equity side, let's assume two binary outcomes. The first is the market's down 20% over the next 2 years. And the second, you're up 20%. In scenario one, your equity lost $12,000. But when you add in the $3,400 from your bonds, your net loss is $8,600, or negative 8.6% return. In scenario two, you made $12,000 in stocks. And when you add in your fixed income return, you bump up your gains to over $15,000 or better than 15% return. You captured 77% of the return of an all-in equity portfolio and 43% of the downside when the market's headed south. Every period will be different, but not a bad risk-reward trade-off and very easy to put in motion. Private credit. Private credit has exploded in the last 10 years. Deutsche Bank, in a recent note, points out that financing is generally floating rate and loan sizes are between 10 and 250 million, with terms as much as 400 basis points above public debt. That's a significant premium. However, this is not for everyone. There is an illiquidity premium built in. Funds like this often have specific times when you can access your principal. Floating rate securities. They can work well, especially in a rising rate environment. They have advantages, but also have their share of risk. On the plus side, yields follow overnight lending rates, and if rates are rising, so is income. On the downside, credit quality is generally lower. And as you can see in this chart, during COVID, they cratered, offering no protection at all. Long-short equity, hedge funds, even ETFs. They often have low correlation and sometimes even inverse correlation. I've used several in the past, and I can tell you it is better to use a basket approach. Over the long run, this has been an excellent alternative. But I can tell you running long-short is challenging, and few managers ever master the art. You need to do your homework here. Look at performance through a full market cycle, not just a bull or bear market. Remember, past performance is not indicative of future returns. In the end, some combination of all of the above is maybe the best approach to a revamped 60-40 mix. Will long-term fixed income ever resume its historic role? Look, I think in severe economic and geopolitical events, long-term treasuries will provide the inverse correlation you seek. But those events are often fleeting and repair themselves quickly. There are lots of other choices we haven't even gone into today, including structured notes, buffered ETFs, and derivatives. Hope to get to all of these in the weeks ahead. All right, that's it for this week. If you want to learn more about yours truly or the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is the Money Runner.